This is not silver. This is not the S&P 500. This is the relationship. This is the relationship between real assets and financial assets. And when this ratio moves, entire market regimes change. Right now, this ratio is doing something that has only happened a handful of times in modern financial history. Most investors are completely blind to it because Wall Street does not want you watching ratios. They want you watching prices. Prices distract. Ratios reveal. So this chart measures one simple thing. How many units of the S&P 500 it takes to buy 1 unit of silver. When the ratio is falling, financial assets dominate. Leverage expands. Liquidity is abundant. Risk is rewarded. When the ratio rises, real assets outperform. Monetary credibility is questioned. After all, we're just printing paper here. Equity valuations compressed. Volatility accelerates. Don't forget to join this channel in order for you to know where the next big risk is going to come from, because that's what this channel is about. This channel is about looking for black swan, the next risk in the system. That is what it's about. And that is very important right now. So this ratio is not a trade. It is a macro signal, and it is cyclical, violent, unforgiving. Look at the two massive bottoms highlighted in this chart. Late 1990s, late 2010s to early 2020s. Both periods share identical conditions. Extreme liquidity valuations, technological euphoria, falling real rates, central bank credibility. That is important. Commodities dismissed as dead money. And what followed? A vertical repricing, look at it, of silver relative to stocks. It wasn't gradual, it was not polite, it was explosive. So 2000 to 2011, from the early 2000 to 2011, as you could see, the S&P 500 went sideways in real terms. Silver increased multiple fold. Volatility exploded. Monetary policy lost credibility. Asset allocation rules broke down. 2000 to 2011. That was a pretty, because 2000 was basically the dot-com bubble. And then before you knew it, we had 2001. Before you got to 2001, we had 2000, 2007, 2008, which was a financial crisis. So that wasn't good. So the ratio didn't rise because silver was speculative. It rose because stocks were mispriced against reality. This is critical. Silver doesn't need to be perfect. Stock just need to be wrong. And then people move away from paper asset to hard asset. 2000. The bottom is more dangerous than 2000. This bottom is more dangerous than 2000. Why? Because debt levels are exponentially higher. Monetary intervention is permanent. Fiscal discipline no longer exists. Demographics are reversing. Geopolitical risk is structural, not cyclical. In 2000, the system could absorb shocks. Today, the system requires inflation to survive. This changes everything. Silver today sits at the intersection of monetary hedging, energy infrastructure, electrification, defense technology, supply chain fragility. This is not a precious metals trade. It is a monetary and industrial convergence. Stocks, by contrast, and don't forget, subscribe to this channel because what I do for you on a daily basis, I look for risks. Forget the idea of looking for stocks that are going to go up in value. What you need to worry about, because when the market goes up, they all go up. What you need to worry about is what happens to the next downturn. What is going to happen if inflation gets out of control? What's going to happen if the economy starts collapsing? Although this is not happening right now, but inflation could be a concern. Stocks are overvalued. When is it going to reach the top? That is what we're looking for. Stocks, by contrast, are priced as if rates will fall painlessly. No. I mean, if rates fall and you have inflation, that is not a good sign. Let me tell you. People will lose their jobs. The economy will need to stop for them to control inflation like they did in the 1980s. Earnings will compound forever. Liquidity will remain infinite. That is what the stocks are priced in right now. That is not investing, right? That is faith. That's literally what's happening, right? So both every major upside break in this ratio, the same thing happens. Take a look at it. Time compression, years of boredom, false starts, repeated disappointment. This is how markets shake out weak conviction. This move does not begin when consensus turns bullish. It begins when everyone stops watching. Look at where we are now. Look at it. If this ratio breaks higher decisively, as you could see it is starting to, equity multiples will compress, volatility re-enters permanently, passive investing stops working. Just let it keep buying. Real assets regain monetary relevance. Real assets, gold, real estate, stuff like that. That is not about silver going up. This is about financial assets losing privilege. Markets don't warm politely. They whisper through ratios. And this chart is whispering the same message. And that message is quite important. Financial assets are priced for perfection. Reality is not. When this ratio moves, it does not ask question. And when it breaks, it changes everything. I want you to take that to the bank and think about it, because that's going to impact your money, your job, and the economy very soon. This is a Bloomberg chart, actually. I got this from Bloomberg. And basically what it shows you is, look at it, right? Historically, the chart was doing quite well, right? From the 90s, 94, 90s. Look what happened since 2004 when obviously you know what happened 2000 with the story with what happened with the dot-com bubble, right? Lasted, collapse in 2000. It took about 15 years to get that money back. Then, of course, we had 2001. And then before you know it, by the time we were done, 2004, 2005, and then 2007, that was the great financial crisis. And look what's happening to the ratio of silver to the S&P ratio. And this is what's going to happen now. You could see it popping up already. Look at the right of the chart. The right of the chart basically is 2020 to 2024. The middle is 2010 to 2014. This is a chart as of 2025. And the source is Bloomberg. So Crescat Capital LLC came up with this chart. So, you know what I mean? We have a track here. And you're telling me that this is going to collapse? And no, and especially what's everything with the fact that, you know what? We don't trust the financial papers anymore. We need hard currency. I think the smart money has started doing that. Take a look at the video that I did on JP Morgan. Let me show you another one. Take a look at this one. This is the oil to gold ratio. Let's see what it says. The oil to gold ratio has collapsed to 0.5 grams of gold per barrel. This is the lowest level in modern financial history. Lower than the 1970s oil shocks. Lower than the global financial crisis. And lower than the COVID panic. This is not noise. This is not a curiosity. This is macro warning flare. What this means is whenever this ratio breaks down like this, it is not that oil that is sending the message, it is gold. And gold is telling you something deeply uncomfortable about the global financial system. The oil to gold ratio measures how many grams of gold it takes to buy 1 barrel of oil. When the ratio is high, energy is expensive relative to money. When the ratio is low, money is expensive relative to energy. Historically, this ratio mean reverse, meaning it goes back to the average, right? But today, it has broken through every historical floor. Gold hasn't merely risen, it has reasserted itself as money. Money, not paper money, gold money, hard assets. Oil hasn't merely fallen, it has been financialized into irrelevance. That combination only happens during periods of systematic stress. You know, the systemic stress. Look at the chart. When did we get to those levels? Well, you know, in the 70s. The 90s, 70s, well, we know what happened there, right? And then, which was basically the oil crisis. Then we have the situation in the 90s, the Gulf War, right? Then we have the Asian financial crisis. Look at all the bottoms. The oil prices decline. Then we have to 2010, 2020, 2024 because of COVID. And now we're here. But we're at the lowest level. We're at the lowest level we have been in quite some time. Look at it. Look at the detail of the chart. Look at the events that are tied to it. And basically what you're seeing is a situation that is going to be very complicated very soon. Right? So what do we want to talk about? Well, basically, or gold hasn't merely risen, it has reasserted itself as money. Oil hasn't merely fallen, it has been financialized into irrelevance. Even major spike or collapse of this chart coincides with monetary regime shifts. In 1971, there was the Bretton Woods collapse. Gold decouples from the dollar. The ratio destabilizes. In 1973, Arab oil embargo. Energy weaponized. The ratio explodes upward. In 1979. Iranian revolution, inflation spirals, gold dominates. And in 2008, we have the global financial crisis and credit freezes. Gold surges relative to everything that is real. And in 2020, we have the pandemic shock. Oil collapses to near zero. Gold holds. And now we are seeing something worse. Gold is rising without an oil shock. Oil is cheap without a global depression. This tells you the problem is not supply and demand. The problem is trust. Why is this time different? This time, the collapse is being driven by three forces simultaneously. One, monetary debasement. That's right. They know the dollar is getting devalued. First, monetary debasement. The governments are issuing debt at a scale that dwarfs wartime levels during the so-called peace. Two, structural energy dominance. Shell efficiency gains and demand fragility have capped oil pricing power. Third, financial repression. Real rates remain negative or barely positive, forcing capital into hard stores of value. That's the thing with gold. Gold is not rising because it is loved. Gold is rising because nothing else is trusted. This ratio is not telling you oil is cheap. It is telling you money is broken. Many investors misread this. They say, oh, oil is dead. Oh, energy doesn't matter anymore. That is dangerously wrong. Energy is the foundation of all economic activity. What has changed is who captures the surplus. Oil has been capped by over-financialization, policy intervention, ESG capital constraint, and demand volatility. Gold has no such ceiling. Gold does not depend on growth. Gold does not depend on policy approval. Gold does not default. You see why people are going for gold? Both are natural resources. But when oil collapses against gold, it means productive assets are losing ground to monetary assets. This is a late cycle behavior. Basically, markets are really pricing the following. Persistent inflation volatility. Again, we believe that inflation is going to remain. Rising sovereign debt risk. That's true. Currency dilution. Lower real growth. Political interference in markets. I mean, come on. They're all over the place. Not just in these countries, but in Europe and everywhere. This is not a bet on recession. This is not a bet on financial disorder. This oil to gold ratio is effectively saying the following. I would rather own something no one can print than something that depends on stable global demand, because obviously oil is tied to, consumption. This is not optimism. That is survival instinct. Historically, ratios like this do not stay at extremes. Resolution happens one of three ways. Number one, oil prices surges violently. 2, gold corrects sharply. And 3, the currency denominator collapses. That is the issue that you need to worry about. If oil rises to restore balance, inflation returns with force. If gold falls, confidence must return, and it hasn't. This suggests monetary instability is persisting. So one final warning on this. This chart is not about oil. This chart is not about gold. It is about the pricing of trust. When gold buys more energy than ever before, it means the system is hedging against itself. Ignore this ratio at your own risk, because every time it has screamed like this in the past, something in the financial world eventually broke. And it never broke where people expected. De-dollarization is already happening. Muammar Gaddafi wanted to do this, ended up dying by the hand of his own citizen. Very sad. Yes, indeed. He tried to join but didn't work out so good for him. So let's keep that in mind, people. All right, it's not like I didn't warn you in ways that are very complex, but also very, very, very important. Let's take a look at this little guy here. Let us take a look at volatility. Volatility is very important right now, and let's find a way to measure it and take a look at it. Let me start with a statement that will sound comforting and should terrify you. Every time volatility collapses, investors feel safer. And it behooves you to understand this. Every time the VIX falls below 14, the narrative becomes the storm has passed, and every time without exception, risk quietly re-enters the system. Today's chart does not show optimism, it shows conditioning. Because what you're looking at is not a bullish signals in isolation, it is a cycle, and cycles always end. At the top, you see the S&P 500, obviously, climbing steadily over decades. Below, the VIX, American fear gauge, spiking violently during the stress, and then collapsing. The study isolates moment when the VIX falls from above 26 to below 14.5 within 3 months. This matters. A VIX above 26 represents panic. A VIX above 26 represents panic. Below 14.5, it represents complacency. This is not a normal decline in volatility. This is a fear being aggressively crushed. And every time this happens, the market behaves in a disturbing, consistent way. Let's talk about what happened after volatility collapses. 1 week later, on average, markets are up. 2 weeks later, up again. 1 month later, up again. 9 months, up every single time in the data set. 1 year later, again, 100% positive outcome historically. And that's a trap. Because investors are trained to extrapolate returns, not risk. People are focusing on return, and this is why I want you to join this channel, because what I do is I really trying to identify the risk in the system. Not telling you which stock is going to go up next. Nobody knows that, but I could tell you risk is there. Look closer. Now, let's shift your attention to the final column. Maximum drawdowns within 1 year. This is the price paid for complacency. While markets often finish higher after volatility collapses, they frequently experience violent interim losses, double-digit drawdown, sudden air pockets, liquidity shocks. This is not stability. This is suppressed volatility snapping back. The market is calm not because risk is gone, but because it has been temporarily anesthetized. What does this pattern repeat? Well, because volatility is not just fear, it's price discovery. Where's the risk? Option sellers dominate. Systemic strategies lever up. Risk parity increases exposure. Volatility targeting funds de-risk and re-risk automatically. The entire market structure becomes long gamma, long leverage, and short uncertainty until something breaks. And when volatility returns, it doesn't trickle back. It re-enters violently. Investors make the same mistake every single cycle. They interpret low volatility as safety. Oh, the VIX is low, so everything is safe. No, low volatility is fragility. Think of it next time. Low volatility is fragility. The absence of turbulence does not mean the plane is safe. It only means that often means that the engines are running harder than you realize. The VIX collapsing from panic to complacency is not a signal to relax. It is a signal that risk is being mispriced again. Look at where we are today. Volatility has once again collapsed. The markets are confident, right? Can't lose. Narratives are clean and positioning is grounded. This is not a warning of an immediate crash. This is not about this. This is not how this works. This is a warning that future volatility is being stored, not eliminated. Every calm regime plants the seed of the next shock. Professionals do not read this chart and say, hey, buy aggressively. They say, tighten risk controls, reduce leverage, expect drawdowns. Maybe it's time to start buying some options. And if you join my Patreon channel, I will show you how to do it. I will explain to you how to do it. There's many ways for you to hedge yourself in this market, because the danger is not the direction of the market. It is the speed when volatility returns. So remember this. When the VIX collapses, markets don't become safer, they become more brittle. Returns may still come, but the margin for error disappears. This chart is not bullish, it is conditional. And conditions always change. If you understand volatility, you don't fear it, you fear its absence.